You could save $500 every month for 25 years and still run out of money in retirement. In this video, I will show you why you can't save your way to a wealthy retirement and what to do instead. I'm Toyin, a CPA and financial planner here in Canada. I'm glad you're here. If you're in your 40s or 50s and you've been focused on just putting money aside, this one's especially for you. Saving money is not bad. In fact, it's essential. You need an emergency fund, you need cash reserves, and there's a security in watching that savings account number go up. But saving alone is a losing game over time. And you're not alone if you've been doing this. A recent TD Bank survey found something really eye-opening. Over a third of Canadians, 35%, are contributing to a savings account only, instead of investing in things like TFSAs or RRSPs. Even more telling, in just the first half of this year, money sitting in Canadian savings and checking accounts grew by 9%. At the same time, Canadians pulled money out of investment funds at the highest rate since the pandemic started. So, if you've been keeping your money in savings, you're following what the majority of Canadians are doing. But that doesn't mean it's the right thing to do. Here's why. Let's say you put in money into a high interest savings account earning about 3% per year. That sounds pretty good, right? But inflation in Canada typically runs between 2 to 3% per year. So your real return, the actual growth after accounting for rising costs, is somewhere between 0 and 1%. That means your money is barely keeping pace with the cost of living. It's not growing your wealth. It's just sitting there. And if you're someone who's felt like you've been doing everything right, saving consistently, avoiding debt, being responsible, but you still don't feel like you're getting ahead, this is probably why. Many of us default to just saving because saving feels safe. You can see the number in your account. It doesn't go down. There's no risk of loss. And for a lot of people, especially if you grew up in a household where money was tight, having cash in the bank represents security. Investing, on the other hand, feels scary. The stock market goes up and down. You hear stories about people losing money. And if you're already feeling behind on retirement savings, the last thing you want to do is take on more risk. I completely get that. I know professionals in their 40s or 50s who make excellent incomes, who have saved diligently, but who are terrified to move that money into investments. And the data backs this up. A recent survey found that 45% of Canadians don't feel confident in their investment knowledge. That lack of confidence keeps people on the sidelines. In fact, a third of Canadians have never invested at all. But the real risk isn't in investing. The real risk is in running out of money in retirement because you played it too safe. When you keep all your money in savings, you're choosing the certainty of slow growth or some loss over the probability of wealth building. And that choice has a cost. Let's say you have $500 per month to put away for the next 25 years. You put that $500 every month into a high interest savings account, earning 3% per year. After 25 years, you'd have about $223,000. Not bad, right? You saved consistently for a quarter of a century. You were disciplined. That's real money. Now, same $500 per month, but this time you invest it in a balanced portfolio. Maybe a mix of index funds, ETFs, a diversified approach. Historically, balanced portfolios in Canada have averaged around 6 to 7% returns over the long term. Let's be conservative and say 6%. After 25 years, you'd have approximately $349,000. That's a difference of $126,000 just by moving your money from saving to investing. The gap gets bigger the longer you invest because you're not just earning returns on your contributions, you're earning returns on your returns. That's compound growth, and it's the closest thing to magic that exists in personal finance. If you're in your 40s right now and you've been saving instead of investing. I know what you might be thinking. I don't have 25 years. I've already lost time. Well, you have more time than you think. If you're 40, you've got 25 years until 65. If you're 45, you've got 20 years until 65 and could even work to 70 if you want. And even after you retire, your money needs to last another 25 to 30 years. So that growth period isn't over at retirement. It's just beginning a new phase. So here's what to do. Step 1, keep your emergency fund in savings. You want 3 to 6% months of living expenses in a high interest savings account. This is your safety net. Don't invest this money. Cash is king for emergencies. Step 2, identify your investing money. This is money you won't need for at least 5 to 7 years. Could be your RRSP contributions, your TFSA room, or just extra cash flow. Once you've identified it, commit to moving it from saving to investing. Step 3, start simple. You don't need to become a stock picker or a day trader. For most Canadians, a low-cost diversified portfolio of index funds or ETFs is the smartest move. You can set this up through your bank, a robo-advisor, or a discount brokerage. Step 4, automate it. Set up automatic monthly contributions just like you've been doing with your savings. The consistency matters more than the amount. Step 5, don't check it obsessively. This is long-term money. The market will go up and down. That's normal. Your job is to stay the course and let compound growth do its magic. And listen, if this feels overwhelming, that's okay. You don't have to do this alone. This is exactly what financial planners are for. We help you build a plan that fits your timeline, your risk tolerance, and your goals. Here's what I want you to take away from this video. Saving is the foundation, but investing is how you build wealth. If you've been a diligent saver, you've already proven you have the discipline. Now, it's just about redirecting that same discipline into a strategy that works with time instead of against it. You may have lost some time, but now is the best moment to make this shift. And 10 years from now, you're going to be so grateful you did. If you're ready to take the next step, watch my video on how to get from zero to your first $10,000 in investments. I'll walk you through exactly how to start. I'll see you in the next video.